You're losing money in two ways you can't see: fees and over-diversified deadweight. That ends today. In the next few minutes, I'll prove why simplicity beats stock picking and why 3 Vanguard ETFs can change your retirement trajectory with the 10-year results and expense ratios down to the basis point. You'll see exactly how a $10,000 stake in growth and dividend leaders compounded and how much you actually kept after costs. We'll break down the roles: VOO for broad market growth, VGT for concentrated tech upside, and VIG for steady, durable income. First, we have to expose the quiet leak that's been draining your returns. The invisible leak. Fees and fake diversification is where most portfolios quietly fall behind. What if the biggest drag on your future wealth isn't a market crash, but a quiet 1% fee and a pile of meh stocks? You don't see it day to day, but it siphons growth every year, and a lot of young investors fight the wrong enemy. They chase alerts, tips, and momentum, while handing over a slice of returns to funds that look smart on paper and sluggish in practice. The cost doesn't show up in a single line item. It compounds against you, and it does it for decades. Let's break down the simple math. Take $10,000 growing at 10% for 30 years. That becomes about $174,494. Now shave off just 1% for fees so you net 9%. After the same 30 years, you're at roughly $132,677. That's roughly a $41,800 gap created by a tiny annual skim. You didn't make a bad pick. You just paid a standing toll, and compound interest worked in reverse for the fee collector instead of you. Here's the second leak: fake diversification. Many funds and DIY portfolios spread across too many mediocre names, which mutes the impact of actual winners. The S&P 500 doesn't have that problem. It's designed to be self-cleansing. Laggards exit, leaders enter, and the list updates as the economy shifts. You don't have to babysit it or guess who's next. Meanwhile, individual investors tend to cling to losers, hoping for a rebound that never quite arrives, and that dead weight drags on long-term returns. Behavioral drag makes it worse. Panic selling during a slide, jumping into whatever style outperformed last quarter, and flipping holdings for a fresh start not only lock in losses, but also trigger taxes in taxable accounts. That means you pay now, instead of letting gains compound untaxed for longer. It's the opposite of what you want if your goal is steady wealth building. This is where structure matters. Vanguard's ETFs pair low expense ratios with an in-kind creation and redemption process that typically reduces capital gains distributions. You keep more of what you earn because you're not forced into annual taxable payouts just for holding shares. This structure is especially powerful for Americans in their peak earning years, roughly ages 35 to 65, because higher tax brackets magnify the benefit of deferring capital gains. Over a decade, that tax efficiency and cost control can save you a meaningful chunk of money and keep more capital compounding on your behalf. The fix isn't to add more tickers, it's to raise the quality bar. Fewer, better funds beat a drawer full of symbols you never truly manage. Keep the core exposure that upgrades itself. Add targeted growth where innovation compounds, and include a discipline that rewards durability instead of yield traps. You don't need 20 funds. You need the right 3 to cut costs, reduce mistakes, and capture market growth without babysitting your account. Wall Street doesn't love this approach because low-cost, tax-efficient funds don't generate big fees for them. That's exactly why you should use them. Start with a foundation that quietly promotes winners and retires laggards, then build from there. If you could own the automatic winners of the US economy without guessing, would you? Let's anchor the core first. The bedrock, VOO for broad market compounding. That's the promise of VOO, Vanguard's S&P 500 ETF. It gives you broad exposure to the largest U.S. companies and leans into market leaders as they rise. Underperformers don't linger forever. They get replaced by stronger entrants through a rules-based process, so your portfolio stays aligned with the current engines of growth without you trying to outsmart the market. You're buying pieces of businesses you already know: Apple, Microsoft, Amazon, Alphabet, Berkshire. These are the firms building platforms, logistics networks, software ecosystems, and cash machines that drive profits and productivity gains. You get their earnings power as a group, not a bet on one. When leadership shifts, the index updates. You don't need to monitor earnings calls or guess which sector turns next. Now the trade-off. VOO is still 100% stocks. That means the ride can feel rough. In 2022, the S&P 500 fell around 18%. In 2008, the drop approached 40% during the financial crisis. Those are real drawdowns, and you have to accept that volatility as the price of higher long-term returns. The key is horizon. If you measure in months, volatility dominates. If you measure in decades, earnings growth and reinvested gains do the heavy lifting. If you're within 5 years of retirement, a pure VOO allocation can be dangerous because a deep drawdown could coincide with when you need the money. That's when stability and cash flow become essential, something we'll solve for later with a separate sleeve. Over the last 10 years, VOO delivered roughly a 13.6 annualized return. Put $10,000 to work and without trading, it grew into the mid-30,000s. That's the effect of compounding when you let profits roll and avoid unnecessary moves. You didn't need to pick a single winner, time entries, or rotate sectors. The index handled the upgrades for you. That self-cleansing mechanism is quiet but powerful. Companies meeting the index's criteria remain. Those that fall behind or shrink exit. New leaders, whether they're chip designers, cloud providers, or healthcare innovators, enter as their market footprints expand. Turnover is rules-driven and measured, not a churn fest. You benefit from the economy's evolution without triggering constant transactions. Costs matter just as much as discipline. VOO runs at a very low expense ratio, keeping almost all of your return in your account. Lower fees compound like returns do. A few basis points saved each year translate into thousands kept over decades. Add in the tax efficiency typical of ETFs, and you're deferring capital gains until you choose to sell instead of absorbing routine distributions. For ages 35 to 65, VOO can be the automatic growth engine. You have the runway to ride out recessions and the patience to let business fundamentals compound. You're essentially outsourcing the maintenance to a rules-based system and focusing on what you can control: contributions, costs, and behavior. But broad exposure isn't the only way to grow. One slice of the market has outpaced the rest for years, and used carefully, it can amplify this foundation without turning your plan into a gamble. The accelerator. VGT and the tech advantage takes that growth core and tilts it toward the most productive corner of the market. Tech has carried a huge share of market gains, and that's where VGT comes in. It's concentrated exposure to technology, cloud services, semiconductor leaders, software platforms, where new products and network effects can scale fast. You're not guessing which startup wins. You're buying the sector's most established engines and letting innovation stack on itself. VGT is market cap weighted, so the biggest forces do the heavy lifting. Apple, Microsoft, and Nvidia sit near the top. And when these firms expand margins, launch new lines, or capture more share, their larger weights funnel more of those gains into your results. This structure reduces the need to rotate between subsectors like chips, cybersecurity, and SaaS because success tends to flow toward the dominant platforms. You still get depth, hundreds of holdings, but the index channels momentum to the leaders. Now the trade-off. Tech can fall harder when the cycle turns. In rough years, VGT can drop far more than the broad market. And that stings if you're close to needing the money. In 2022, for example, the S&P 500 fell about 19%, while VGT slid nearly 30%. That's why time horizon matters. Younger investors can absorb bigger swings and keep buying through drawdowns. Older investors often prefer a calmer path, even if that means giving up some upside. Volatility isn't a flaw here. It's part of how high-growth sectors reset and set up the next leg. Over the last decade, VGT delivered roughly 330% total return with an annualized number around the low 20s, while charging a modest 0.10% expense ratio. That cost discipline lets more of the sector's gains stay invested, which is critical when compounding at higher rates. Here's the concentration payoff in dollars. $10,000 in VOO grew to $35,000. But in VGT, that same $10,000 grew to over $73,000. That's the power of funneling more weight to the winners when the sector trends persist. The backdrop hasn't been a fad. It's been driven by durable engines, AI workloads growing across enterprises, automation removing manual processes, cloud adoption standardizing how companies run, and semiconductor cycles powering everything from data centers to devices. Treat VGT like a turbocharger, not the whole engine. You use it to tilt your growth bucket toward the most productive corner of the market, assuming you don't need that cash for 7 to 10 years. If you're over 50, consider trimming to reduce stress in ugly markets and protect withdrawal plans. If you're under 35, a measured allocation can lift long-run compounding without forcing you to time entries. For 35 to 45, a higher tilt can be reasonable, then scale it back as retirement approaches. Used thoughtfully, VGT can raise your trajectory while keeping the rest of your plan grounded. Growth is powerful, but it works best alongside a steadier source of income that doesn't rely on guessing cycles or chasing headline yields. That's where a disciplined dividend growth sleeve earns its place. When growth pulls hard, you still need something that steadies the ride. The safety net. VIG's dividend growth discipline does exactly that. Want income that tends to rise without chasing shaky 8% yields that vanish when you need them most? Dividend growth is the calmer lane. VIG focuses on companies that raise their payouts every year for at least a decade. The explicit quality filter that screens out the junk. Firms that can lift dividends through different cycles usually have strong cash generation, disciplined capital allocation, and management teams that don't promise what they can't sustain. You're aiming for reliability and momentum in the payout itself, not a headline yield that looks big because the stock is sliding. Here's the catch many miss. A high yield often signals stress. When profits fall, boards defend the dividend until they can't, then cut, and shareholders feel it twice. Lower income and a falling price. Dividend growth flips that script. The rising payout is the tell that the business is healthy. Yes, it can lag in frothy bull runs when speculative names sprint, but the trade-off is fewer gut punches when markets turn. Let's break it down with what matters in rough patches. Dividend growth funds have historically shown smaller drawdowns and steadier cash flow during downturns compared with the broader market. Why? Their holdings tend to be established operators with durable advantages and cleaner balance sheets, which gives them room to keep paying and even raise checks when credit tightens. That steadiness isn't just comforting, it changes behavior. When you see income continue, you're less likely to sell at the bottom to protect yourself. Costs stay low here too. VIG carries an expense ratio around 0.05%, extremely low, which means more of your return remains working. Over the last decade, performance has hovered near the low double digits annualized, roughly 11.9%. It didn't chase the hottest trade, but it kept grinding with less drama, which is the point. Compounding relies on staying invested, and low fees plus lower volatility help you do exactly that. Rising dividends also fight a real enemy: inflation. When payouts grow year after year, your income stream has a chance to keep up with higher prices. That supports a basic budget without forcing you to sell shares at bad times. Instead of harvesting principal during a drawdown, you can lean more on the cash flow and let the share count ride for the eventual recovery. VIG's screen excludes the problem children. Serial cutters and speculative payouts don't clear a decade-long track. That filter leaves you with companies that have proved they can navigate recessions, rate cycles, and industry shifts while still lifting checks. Names in this camp often run strong balance sheets, consistent margins, and repeatable growth engines, which is the sort of discipline you want carrying your income bucket. If you're nearing retirement or you just want smoother nights, VIG slots in as ballast. It won't erase volatility, but it can absorb shocks and keep cash coming so you can hold your growth positions through rough waters. From here, the question becomes how to stitch these pieces into one simple plan you can run on autopilot. Your blueprint. Simple allocations. Real-world discipline puts the pieces into a plan you can execute without second-guessing. You don't need a perfect forecast. You need a structure that keeps you buying through noise, keeps costs down, and keeps your mix aligned with your timeline. Treat this as a starting point you can adjust to your own risk tolerance and income needs, not a rigid rulebook. Here's a clean way to set it up by age. For 35 to 45, tilt toward growth with 50% VOO, 40% VGT, and 10% VIG. You're giving compounding more fuel while keeping a small dividend growth anchor. For 45 to 55, rebalance 60% VOO, 20% VGT, and 20% VIG to reduce sharp swings without abandoning upside. For 55 and up, move to 50% VOO, 10% VGT, and 40% VIG to prioritize stability and rising income while still keeping a modest growth kicker. Adjust a few points either way if you sleep better, but keep the framework intact. Buy these three, set up an automatic monthly deposit, and ignore the news. Now, the real fight. Fear of missing out versus fear of loss. FOMO pushes you to chase heat. Fear pushes you to sell at the worst moment. Automatic monthly buys beat both because they remove decisions at the point of maximum emotion. With fixed contributions, you buy more shares when prices fall and fewer when they run hot, which quietly lowers your average costs and keeps you invested. Time in the market beats timing the market. Place assets with taxes in mind. Vanguard ETFs tend to minimize capital gains distributions in taxable accounts, so you usually defer taxes until you sell. When you have tax-advantaged space, use it. Put the same tickers in IRAs or 401ks to compound without annual tax drag. The combination of low expense ratios and tax efficiency raises the share of returns that stays in your account doing work. Set rules you can follow in a storm. Automate contributions on payday. Rebalance once a year on a date you choose. Not when headlines shout. Write a drawdown plan now. Which bills come from cash, how many months of expenses you hold, and what you'll do if the market drops 20%. If you pre-decide, you won't improvise under stress. Here's a simple checklist. Open a brokerage you can operate easily. Set recurring buys from VOO, VGT, and VIG in the percentages that match your band. Pick a rebalance date and put it on the calendar. Default to holding during corrections and let the rules do their job. If you overthink, you'll start tinkering. If you tinker, you'll add costs and taxes. Add guardrails for behavior. Commit in writing to continue contributions through volatility. If you want an extra step, add a small top-up on broad market drops, say an extra contribution when the market is down 10% or 20%. Keep it modest and predefined. This is how you strip out complexity, keep costs low, and let compounding do the heavy lifting, so the plan works even when headlines don't. Let's close with the core takeaway that guides the whole plan. The biggest upgrade to your plan isn't a new pick. It's stripping out complexity and costs so compounding runs without interruptions. Low-fee Vanguard ETFs keep more of your money invested and working quietly in the background. That steadiness adds up. Start now. Set one small automated buy across VOO, VGT, and VIG this week. Pick a rebalance date on your calendar and commit to 12 months without tinkering. Let the rules carry you through noise and dips. Next time, we'll stack this trio against Fidelity's ETF alternatives and map where each wins on fees, taxes, and drawdowns so you can see which lineup fits your goals.